Hello and welcome to the Weekend Investing Daily Bite of 9th of October. And market started with a bang this morning, but succumbed by the evening, at least on the Nifty. The rest of the market remained reasonably intact. So the weakness that we saw before the state election result, that has taken care of itself. Now it is on to the next event that we are looking for, which is going to be the next elections from a local perspective. On a global perspective, Chinese market cracked 6.5% today, so it's a very mixed emotion going on in the market, whether to follow the Chinese trend for the FIIs or to come back to India. And RBI, on the other hand, in today's meet mentioned that they will be willing to look at a rate cut coming soon. He didn't say it in so many words. He said the horse is gone out of the stable, and now we've been able to, with great difficulty, bring him in, referring to inflation, and we should not let it go out again easily. So those were the kind of his words. But it does seem like that December may be a rate cut in India. So from all those perspectives, market should stabilize, I think. Unless we are going to make a technical head and shoulders pattern on Nifty, which I'll show you on the chart, which is currently underway. And if that breaks, of course, then some hell will break loose. Everything else seems to be reasonably stable on the global front. Tech stocks are doing well. Interest rates expectations in the US has gone down quite a bit. So gold has also collapsed in dollar terms because there's no further rate cuts coming. It seems Trump's rating has gone up dramatically versus Ms. Harris. So that again is a great uncertainty that is going forward. But anyway, so coming back to today's daily bite, we're going to discuss how you can index better than Nifty 50. This is one hot topic that everybody should be aware of. In case you aren't, many of you may be, but a lot of folks are not aware of this. So I'll show you how you can index better than Nifty 50. And of course, please always read the disclaimer. Do also subscribe to the channel if you haven't. It is unlikely that you haven't subscribed so far, but in case you have missed it so far, please do subscribe to the channel. So where is the market headed? Extremely important question. You can see today's market again going and clipping that average, moving average of SMA 40 and coming down. So this is a very, very important psychological point. It just went above 2 days high but could not sustain there. Remember, I've told you many times, unless you see a 2-day high close, you are not really getting into the trend. That is the first indicator for me that potentially a trend is happening that way. At least a 2-day high in that direction, in any direction actually. I mean, once this candle dropped below the 2-day low, I mean, there was good probability we will go lower. We did. Today, if we had closed above the 2-day high, we may have had a good probability of going higher. But right now, that has been hurt. We've come back, clipped the moving average, come back. Now, if you see closely, there is a shoulder here, left shoulder here, there's a head here, and we may create a very tight right shoulder here. If that happens, you are looking at about a 1600 point fall. So we may look at maybe 23,200 back to election day high. If that happens, I think that is a very, very big if, but I'm just saying from a technical chartist perspective, that is a potentially that is a potential that has opened up. Nifty Junior, however, has closed above 2-day high, has closed above the average. So it does seem like that the rest of the market is not following what the Nifty is showing. So plus 1.09% on the Nifty Junior. On the Nifty mid cap, also you can see just about at the average, plus 1.07% here, above the 2-day average here. So looks good on that as well. And small caps is also just about there, not really closing above it, but just about there at 1.24%. So most of the damage of the last couple of sessions has been covered back. I think portfolios have also come back similarly, so should not have been any regret. Again, in Bank Nifty also, you can see it went to the SMA 40 and collapsed back to yesterday's close. So nothing lost really. I mean, we are still where we were yesterday at closing. Bank Nifty is down minus 0.03. But this enthusiasm of having come back and negated this fall has been beaten. So maybe if we go down, then here also you can see a left shoulder, a head, and a right shoulder is possible. And here the fall will be maybe to 46,000 below to election day low. If we break this head and shoulders pattern, there's a lot of ifs and buts. I'm just painting some scenarios that are possible. Momentum trend certainly upwards, 341 gains to 154 declines. So a good outcome there. FIIs continue to sell on the previous session, 8th October down 5,700 crores. DII is pumping in much more than FII dumping at 7,000 crores. So the if you add up all these DII cash inflows, it is much more than the FII inflow. So more than adequate support is getting market is getting from the domestic front. ITC and Nestle uh, were the remarkable falls in today. I mean, FMCG was collapsing, which if I were to sort of try to correlate, normally if a market is correcting, defensives will not fall more than the the aggressive stocks, or you may say the higher beta stocks. But here FMCG is falling today, so it to my sense today it seems that this rally is not getting over. It may go higher, but you know nobody's call really. Reliance 1.6% down, ONGC, Coal India all down on the back of crude oil coming off. HDFC drops at every opportunity, minus 1.08%. You can very well make out that I have no particular liking for HDFC Bank, but in one of our strategies, we've just recently added this. So yeah, I mean, I hope it does well. SBI, Bajaj Finance, Bajaj Finserv all did well. Maruti did well. Tata Motors did well. Trent has been continuously doing well after coming into Nifty also, which is a surprise. But that's where things are. The Nifty next 50 looks more green. So you had only a couple of stocks which were really red. Other than that, the capital goods, Siemens, ABB, Bosch, all doing well. Divi's Lab doing 7.9%. This has come out of Nifty and it has done very, very well. DMart up 4%. You had Lodha up 3.6%. So really good moves on some of these stocks. Sectoral trends, mixed bag. FMCG, energy down, real estate, pharma up. Very weird kind of combination, I would say. Real estate and pharma to be at the top today. Pharma is a defensive and real estate is an offensive sector. Both to be up together is kind of strange. Autos, PSU banks also managed more than 0.5% gain along with IT. Nothing exceptional other than that. Mostly sectors are still red for the week gone by. Uh, Real estate is sort of stuck in this range. Phoenix Mill, Oberoi Realty, Macro developers, Lodha actually, Prestige, TLF, all making some ground. So real estate is not really collapsing, and this talk of potential rate cut is providing some fillip to the real estate market. Jayaprakash Power Ventures, dramatic kind of moves in the last 2 days. Yesterday it was like 17 rupees, today it is 22 rupees. So amazing kind of moves are happening in this small stock. Of course, on a very long term basis, it went from 70 rupees to 30 paisa and from 30 paisa to 22 rupees. So we did have it somewhere here, but I think, or sorry, somewhere here, but didn't really make any significant amount of money. But on a chart basis, on a monthly, 3 monthly basis, you can see it has kind of bottomed out, and about below 10 rupees is where the stop should be. Other than that, it may continue to rally. So let's come to the topic of the day. Can you index better than Nifty 50 is the topic. So let's see how equal weight Nifty did till COVID. So between 2013 and till COVID, you had 39% gains on Nifty and 22% gain on Nifty equal weight. So what is Nifty and what is equal weight? Nifty is of course 50 stocks in the given weightage, where weightage of certain stocks are very, very high. And Nifty 50 equal index is that index where all stocks are kept at equal weights. So it performs a bit differently from Nifty over a period of time. So before COVID, Nifty equal weight was underperforming, uh, and post COVID fall, equal weight has really outperformed. So 68% on Nifty 50 equal weight and 47% on Nifty since COVID. And this was financial 24, 68 versus 47, and then in the last 18 months, and then since COVID, 293% on equal weight versus 209. So now the gap has quite dramatically gone up, and it is significantly more because the heavyweights of Nifty are not performing as well. From pre-COVID peak, if we see, I mean, the gap is 157 versus 102, and Nifty 50 equal weight to Nifty 50 ratio chart is showing that, it kind of bottomed here at COVID, and then completely it shifted towards the equal weight post that. So the concern with Nifty 50, the original index, is the weightage skew. So cumulative weight of top 10 constituents of Nifty 50 has been continuously going up from 2016 till about 2020, you can say, and gone up from 50% to 65, 63%. So just 10 out of 50 stocks hog 63% of Nifty, and the rest 40 stocks only get 37% weight. So that is the situation. Cumulative weight of constituents, top 5 was 41.8, top 10 was 60.9, top 15 was 63.9. This is till January 21. Whereas in equal weight, it would be 10, 20, and 30% roughly. And then as per Nifty 50 index, for instance, Reliance is weighted at 10%, whereas in equal weight, it is 2%. HDFC Bank is 9.3%, in equal weight, it is 2%, so on and so forth. So stocks which were at the bottom of the Nifty, so Bajaj Auto, Coal India, let's say Bharat Petroleum, Divi's Lab, they were at 0.5%. Or all these put together was only 5.4% as of April 23. Whereas in equal weight, of course, they will be much higher at 20.4%. Now, what has happened? These bunch of stocks have done really well in the last few years. And hence, because they had very low weights, they did not add so much to the Nifty. So if your portfolio is skewed towards certain stocks, they better perform, because if they will not perform, if they will underperform, your entire portfolio is going to underperform. So market regime will keep shifting from time to time. Sometimes it is going to be banking finance focused, sometimes it is going to be pharma and auto, sometimes it is going to be crude, oil and gas or energy. So concept of just having concentrated allocations towards certain industries may not continuously help you all through. And index investing is, in my view, just a starting point. If you're coming new to the market, you want to get your feet wet, you don't know much about the market, you can do index investing for some time. That is fine. But then indexing is not the most efficient way of getting returns from the market. You can improve on the index. You can improve by way of trying to select the strength from that index itself, so that your strategy can improve on that base index by removing the weakness from that index, which most momentum strategies do. So momentum is not only bias free in terms of weightage, but it also goes further, that if you have 50 stocks and to top 20 are performing, middle 20 are sort of average, and bottom 10 are crazily underperforming, then why should I, as an indexer or an index investor, why should I invest in those stocks which are underperforming? Let me invest in the top stocks, or maybe top and averagely performing, at least. Like for example, uh, index is very late in throwing out underperforming stock. So I remember Yes Bank was in Nifty when it was at 400 rupees. Now, as an index investor, you were some component of that Nifty was allocated to Yes Bank. So you were a part of you were an investor in Yes Bank by proxy. And then Yes Bank fell from 400 till 22 rupees at one point, and Nifty eliminated Yes Bank from its constituents at 22 rupees. So all this while, when the stock was dropping from 400 to 22 rupees, you were invested whether you liked it or not. Now, if you were selecting stocks out of the index, choosing strength, giving them equal weights, then you would have chucked it out at maybe 250 rupees or 300 rupees or whatever may have been the price. You would not have waited till 22 rupees. So you are having to pay for underperformance because somebody is making that basket and giving it to you, and you can't select what is there inside the basket. That is the issue with the simple indexing. Of course, for some people, I mean, if they're getting 12%, they're very happy. And even if you compound at 12% for very long periods of time, it is not a bad outcome. But if you can do one step ahead, once you have more confidence, you should eliminate those weaknesses from the index and just invest in the strength, invest in the top performing stocks and have equal weights on it. And your journey will be at a very different tangent versus the equal weight versus the regular index. So look at momentum investing in the sense of uh, helping you select strength and staying there with equal weights, rather than having concentrated bets in sectors which may not perform for long periods of time. And of course, your thoughts on this weighted skew is welcome. Please do mention in the comment section. I love reading your comments, and I'll see you in the next video. Thank you so much for watching this, and do like and share these videos if you do. Would appreciate if you subscribe to it as well, and I'll see you the next time. Bye.